So today we are going to look at IS2, which is inventories. So under this IS2, what we are going to look at is first we'll look at definitions, then secondly we are going to look at the scope of the standards, scope of IS2, then we are going to look at the recognition, we are going to look at measurement, then we'll also look at the cost of inventory. So these are the things we are now going to look at under this IS2. So firstly, let's look at the definitions. Under definitions, we have some terms that we need to define. First of all, let's start with inventory. What is inventory? Inventory. This is an asset held for sale in the ordinary course of business. It also includes asset in the process of production, such as work in progress, or asset in the form of materials or supplies to be consumed in the production process in rendering of services, that is raw materials. So any asset that is held for sale in the ordinary course of that business is an inventory, or raw materials that will be consumed in order to produce the final product is inventory, or the work in progress, that is the raw materials that you are trying to transform into finished goods. So this is inventory. So and this standard is talking about inventory in general. So this is one. Then we have NRV. What is the meaning of this NRV? This NRV means net realizable value. Is net realizable value. So this is the meaning of NRV. So what does this NRV mean? This is the estimated selling price in the ordinary course of business less the estimated cost necessary to make the sales. It can also be called as fair value less cost to sell. What this means is that the cost you are expected to sell your inventory. Let's assume that your inventory is, let's say, 100 naira. Then you are going to incur costs in the process of selling this inventory. Let's say you incur, let's say, 20 naira to sell that inventory. So your NRV is 80 naira. That is what it means. That is all. Then and we have a fair value. This is the third one. Now we have discussed what is inventory. We have discussed NRV. Now we are going to look at the fair value. The fair value is the price that will be received to sell an asset or paid to transfer or settle a liability in an ordinary transaction between market participants at the measurement date. That is what fair value means. Then the next thing is conversion costs. So we are going to look at this conversion cost. What is this conversion cost? Is the cost incurred in converting raw materials into finished goods. So let's assume that you bought your raw materials at the rate of 20 naira. Then you are going to convert your raw materials into finished good And what is it free that you are going to convert it to? No, you are going to incur some expenses for you to convert that from raw materials into finished good. Let's assume you incur 5 naira, so you are going to now say, okay, is 25 naira everything. So this 5 naira that you incur, this is the conversion costs. Then we are going to look at carrying amount. So what is carrying amount? This is the amount that assets and liabilities are recognized in the statement of financial position. That is, this your carrying amount is the net book value of an asset. Let's say you have an asset which is let's say 1 million naira. Have an asset which is 1 million naira, and you have depreciation of 200,000 naira. So 1 million minus 200, you have 800. So this 800 is your carrying amount. That is what this is saying. So now we are going to look at there is another one which is impairment loss. Impairment loss. So what is impairment loss? This is the amount by which the carrying amount of an asset exceed its recoverable amount. So how does this work? So now let's assume that you have a carrying amount. Your asset, you are carrying your asset in your books at say 500, but the recoverable amount of that asset is 400, not 500. So what is the difference? Is 100 naira. So this your 100 naira is your impairment loss, because your book value exceed your recoverable amounts. So the 100 naira is now called impairment loss. So now let's look at the scope of IAS 2, which is inventories. So what is the scope of IAS 2? What and what does this standard cover? So we are going to look at the inventories this standard cover. One, we have okay, this is one. We have good purchase and held for sales. Goods purchased and held for sales. So this one is still covers under IAS 2. The goods you purchase, and those goods, they are meant to be sold. The intention is to resell them, so they are covered under IAS 2. Then we have finished goods. So these finished goods, they are the goods that you transform raw materials. You bought raw materials, you change them into finished good. You completed the process for sellings. You want to sell them. So this one also is covered under IAS 2. We have work in progress. Work in progress is the raw materials you are trying to convert them to finished goods. They are also covered under IAS 2. Okay, this is the third one. Then fourth one, we have raw material. We have raw materials. This one is also covered under IAS 2. And so these are the things that IAS 2 cover. Then we are going to look at another aspect where IAS 2 does not cover. Okay, now the first thing is we have work in progress. Work in progress. But this work in progress is under construction contract. Construction contract. So any work in progress that is under construction contract is not covered under IS2. That one is covered under another accounting standard. Then the next one is financial instruments. Financial instrument. So this financial instrument is also covered under another standard, which is IAS 39. So it's IAS 39 that covers financial instruments, not IAS 2. Then we have biological asset. Biological assets. So this is covered under another standard, which is IAS 41, agriculture. So this is the scope of IAS 2. Then now we are going to look at the cost of inventory. Cost of inventory. So what are the components that make up the cost of this inventory? We are going to look at them. First, we have purchase costs. Then secondly, we have delivery costs. Delivery costs. Then thirdly, we have cost of conversion. Cost of conversion. Cost of conversion. Then we have import duties in case of importation. We have import duties. We have transportation and other handling costs. Then we have trade discounts. So but this trade discount, you are going to minus it from the cost of inventory. You're going to remove it from the inventory. Then the third one is any other costs incurred in bringing the inventories to its present location and condition. So when you are calculating cost of inventory, what you will do is you have to include all these items. Everything must be included to arrive at your cost of inventory. Then the next thing now we are going to look at the measurement of inventory. So under measurement of inventory, we have divided into two. We have initial measurement and subsequent measurement. So now we are going to look at the initial measurements. So what this initial measurement means is that the beginning of that asset, what are you supposed to consider as your cost of that inventory? What the standard says is that you are going to use cost at the beginning. That is the initial measurement. You will use the cost of the inventory. Then the subsequent one, that is where you will now use cost of lower of cost value and NRV. So anyone that is lower, either cost or NRV, is the one you will now use. That is what the standard says. But at the initial measurement, that is where you will now recognize your inventory in your books. So now, as I said, uh, at the initial stage, you are going to use costs to recognize your inventory. Then the second, that is the subsequent measurement. This one we use costs. Then subsequent is a lower of costs and NRV. So this is what the standards says we are going to adopt. Okay, then what is the accounting entry? First of all, you are going to debit your inventory and credit bank or cash. This is the record of the cost of inventory purchased or manufactured. This is how it is. Then we are now going to look at what we have as when we have discounts. When we have discount, we have trade discounts. So in a situation whereby you have trade discount and inventory, what are you supposed to do? The trade discount should be considered in driving inventory cost. All the trade discount should be deducted in arriving your inventory cost. Let's assume that you have a cost of 500, then you have a trade discount of 100. So what you are going to recognize in your books is 400 because you deducted that 100 to arrive at 400. That is what the standard says. Then we have a cash discounts. So this cash discount may not be considered depending on whether it was made available on the date of purchase or not. What this means is the date you are purchasing that inventory, are you aware of that discount or not? So that is, we have two treatment there. That is cash discount made available on purchase date. Yes, cash discount made available on purchase dates. So what this means is that the cash discount, you are aware of this discount at the date of purchase. That is all cash discount made available on the date of purchase should be deducted in arriving at the inventory cost, even if you are not certain that the associated condition will be met. Even if you are not certain, just deduct it as far as you are aware at the date of that purchase. So you are to deduct it. Then the second one is, told you we have two conditions under cash discount. The second one is the cash discounts made available after the purchase. The cash discounts made available after the purchase date. So how are you going to treat this? In the first one we said all the discounts deducted. It doesn't matter whether you are going to meet the conditions or not. As far as you are aware at the date of purchase, just deduct it from your cost of inventory. Then the second one is cash discount made available after the purchase. So what are you going to do? Say any discount available after the purchase date should not be affected, should not affect our inventory. irrespective of whether the condition will be met or not. The cash discount available after the purchases should not be recognized until the conditions are met. So you will not recognize that. You will not deduct it until you meet the conditions. That is when you are going to recognize this. Then where is it? Okay, this is it. This is 2, this is 1. So that is what you are now going to look at it. Then we have what we call sales tax. Sales tax, or you can call it VAT. Sales tax or VAT incurred on inventory. The sales tax or value added tax incurred on inventory are 1. It can be refundable or not. So it can be one of these. The tax value are expected to be recovered back from the relevant tax authority. In most tax jurisdiction or law, the sales tax or VAT will not be deducted from the sales tax or value received from sales to customer and settlement. The tax authority will not be at net. What this means is, if sales tax is not refundable or is not recoverable, it means that the sales tax or VAT will be included as part of that inventory. Mark you, what did I say? If the tax is not recoverable, you are going to include it as part of your inventory. That is what this means. Then we have the 2 methods, which is FIFO and weighted average. So these are the 2 methods IAS 2 accepted in valuing your inventory. So thank you so much.